The gold price looks calm on the surface, but the plumbing underneath it is starting to scream. And next week is where that quiet pressure either vents or detonates. Because while most people are staring at the spot chart and debating whether this rally is overextended, the market's real truth is leaking out somewhere else, in the spreads, in the delivery timing, and in the physical premiums that are quietly telling you who actually needs metal right now and who just wants a screenshot. And by the end of this video, you'll have 3 things that most viewers want to see: the hidden detail that reframes the entire setup, the exact calendar triggers that can flip the tape next week, and a simple 2-scenario roadmap with the levels and signals that matter, plus what would break this thesis if we're wrong. Because if one level breaks, the math changes. Now zoom out for a second and look at what just happened. Gold didn't drift higher, it surged. Early this month, it was down in the low 4,300s, and within days, it was trading up in the mid 4,400s. At one point, it printed a fresh record near the mid 4,500s before profit-taking kicked in. Silver was even more violent, running up into the low 80s and then snapping back hard, the kind of move that doesn't just happen, the kind of move that forces people out of positions they thought were safe. And that's the first trap. When a market starts moving like this, the average viewer assumes it's just emotion, hype, mania. But the move you're watching is rarely emotion first. It's usually math first, forced flow second, and only then emotion. And that's where the real pressure starts. Because there is a force that tries to suppress and deny what's happening here. Not some cartoon villain, not a single cabal, but the very structure of how these markets are traded. Big funds that have to rebalance, dealers who have to hedge, systematic strategies that have to reduce risk when volatility spikes. Commodity indexes that literally force buying and selling regardless of what you believe. So even if the metal is fundamentally strong, the path can be a whip. And next week is one of those windows where the whip can turn into a launch. But that's not the part that matters. The part that matters is why the whip is happening now, and what it's doing to the internal signals that tell you whether gold and silver are setting up for the next leg, or whether this was the top of the move for months. Here's the hidden detail most people miss. The most important gold price on Earth is not always the one on your screen. It's the price after location, after taxes, after supply constraints, after refinery capacity, after shipping, after local demand. It's the effective bid. And right now, that effective bid is not uniform across the planet. In India, elevated prices are straining retail demand. Dealers were charging small premiums over domestic prices, but the tone has been buyers are stepping back. When people can't afford the jewelry, demand doesn't vanish. It delays, it downshifts, it moves to lighter pieces, it substitutes. That's demand destruction in real time. Meanwhile, in China, physical premiums widened sharply. That's the opposite behavior. Same metal, same global spot price, 2 completely different realities. And the premium is the market whispering, we need metal here. Not headlines, not opinions, actual bids. And when that divergence shows up, it does something that it's not obvious until you understand the plumbing. It creates an arbitrage magnet. Metal tends to move toward the highest effective bid, not instantly, because logistics aren't teleportation. But inevitably, because traders will always chase the spread if the economics make sense. And that's where the real mechanism starts. Most people think the gold market is one pool. It's not. It's a set of linked pools with gates. Futures and options are one pool, paper. Physical bars and vaults are another pool, metal. Premiums are the gate price between pools. When premiums widen in a major consumer region, that's a signal that the gate is getting more expensive. That's a signal of friction. And friction is what turns paper price into physical stress. But here's the twist. Premium's done to have to stay high for a long time to matter. They only need to spike at the wrong moment. During a delivery window, during tight refinery capacity, during a period of thin liquidity, when the paper market is leaning the other way. That's when you get a snap move. That's when you get the kind of week that changes everything. And next week has all the ingredients. Forced index flows are finishing their work, key macro data hits the tape, and positioning is fragile because both gold and silver have been moving fast enough to trigger risk limits. And the next detail is what flips the whole setup. This week, a massive invisible player has been in the market. Commodity indexes rebalancing. Every year, big commodity benchmarks adjust their weights. If a commodity outperformed, it often gets capped or reduced. And funds that track the index have to sell futures to match the new weights. That's not a view. That's a mandate. And when precious metals have had a huge run, those forced flows can be large enough to push price around for several sessions, even if the underlying demand is still there. Here's why that matters for next week. Forced flows have a start and an end. They aren't forever. So the question isn't just, is gold bullish? The real question is, when the forced selling pressure ends, what happens? If price holds up despite forced selling, that's strength. If price snaps higher right after the pressure ends, that's the tape revealing the real bid that was being suppressed. And if price collapses as soon as the flows finish, that tells you the rally was leaning heavily on momentum and leverage. That's the kind of diagnostic you only get when you understand market structure. And that's why the calendar is the catalyst here. Now layer in the macro trigger. Gold dipped slightly into the end of this week on a stronger dollar, and positioning ahead of the US jobs report, while still holding on to a strong weekly gain. That matters because the jobs report is one of the few data points that can rapidly change the market expectation for rates. And gold, at its core, is a market about real yields and trust. Not because gold hates interest rates in some simplistic way, but because gold competes with the idea of holding cash and bonds. When real yields rise, the opportunity cost of holding gold rises, and the paper market responds quickly. When real yields fall, or the path of future rates looks lower, gold becomes more attractive as a store of value, and flows follow. But Donati fall into the second trap. The metal doesn't need rates to collapse to go higher. It needs uncertainty about the path of rates, and it needs liquidity stress somewhere in the system. Because gold is not just an inflation trade, it's also a collateral and confidence trade. And the last few years have taught markets to price tail risk faster than they used to. That's why we can get record highs, even while the macro narrative is messy. But that's not the part that matters. The part that matters is what happens next week when the market has to digest inflation data, retail data, and the aftershocks of this week's forced flows, all while volatility is already elevated. This is the kind of week where price discovery can slip out of the hands of opinions and into the hands of hedging. And that's where the real pressure starts. So let's talk mechanics, because if you can't explain the mechanism, you don't have a thesis, you have a mood. Here's the simplest way to understand paper versus physical in gold and silver. Spot and futures are where the headline price lives. Options are where reflexivity lives. Physical is where confirmation lives. When the paper market drives price up rapidly, physical buyers often step back temporarily because they don't want to chase. That's normal. You'll hear people say, "See? No demand." But then you look at premiums and you see demand didn't vanish. It shifted. It concentrated. It became selective. It moved to the region or channel that can still pay. Meanwhile, the paper market is not trading gold the metal. It's trading gold exposure with leverage. Futures margins, option Greeks, dealer books, risk limits. And when volatility spikes, paper exposure gets cut regardless of fundamentals. That's why silver is a margin call machine. Silver's market is thinner than gold's, more volatile, and more sensitive to positioning. So when silver runs, it attracts leverage. And when it snaps, that leverage becomes forced selling. Not because the story ended, but because someone hit a risk limit. Someone's broker raised margin, someone's fund cut exposure, someone's vol targeting strategy sold. And that forced selling can temporarily break the chart, even if the bigger trend is intact. But that's not the part that matters. The part that matters is whether those forced sellers get absorbed. Because if they do, the market has just cleaned itself. It has shaken out weak hands. It has transferred risk from fragile holders to stronger holders, and that's when the next leg can begin. Now add the hidden detail back in. Physical premiums are telling you whether absorption is happening in the real world, not just in the paper arena. If China's premium stays elevated while India's retail demand stays strained, that's not bullish or bearish in a simple way. It's a map. It's telling you where the marginal buyer is and what that marginal buyer can withstand. It's telling you whether the global market is being pulled toward scarcity or being pushed away by price. And here's the key. If the premium stays high in a major region, it tends to pull metal flows and support the global price over time, even if day-to-day spot is noisy. But if premiums collapse everywhere, that's a sign the rally is running ahead of the physical world. That's the hidden detail, that's the tell, and that's where the real pressure starts. Now, I want to layer the second mechanism because this is the one that turns next week into everything changes. Options reflexivity. You don't need to be an options trader to understand this, you just need the mental model. Dealers sell options to clients. When dealers are short options, they hedge their risk by buying or selling the underlying futures. The hedging isn't discretionary, it's mechanical. As price moves, the hedge ratio changes. That's delta. And when price moves towards certain strikes, especially round numbers and heavily traded levels, the hedging flow can either dampen moves or accelerate them, depending on the positioning and the gamma. In plain English, sometimes the market gets pinned and sometimes it gets slingshotted. If gold hovers near a big round level into a key options window, dealers may hedge in a way that stabilizes price, creating the illusion of calm. But if price breaks through a level where option exposure flips, the hedging can turn from stabilizer to accelerant. Dealers can be forced to buy into strength, which is fuel for a squeeze, or forced to sell into weakness, which is fuel for a flush. And next week matters because the tape is already stretched, volatility is elevated, and the market is sensitive to macro surprises. One data print that moves yields, and the dollar can kick price into a zone where dealer hedging becomes the move. And that's the part the mainstream misses. They'll say, gold rose because of fear, or silver fell because of profit taking. That's storytelling after the fact. The real story is, flows hit the tape, and flows don't care about your narrative. Because if this one level breaks, the math changes. So let's build the proof stack. Not one argument, not two, 5 layers, minimum. First proof layer, price behavior. Gold has been strong enough to post a big weekly gain even while dipping on dollar strength and positioning. It printed a new record high recently, which tells you the market is willing to pay up at the margin. Silver has been wild, which tells you leverage and reflexivity are present. That volatility is itself information. Second layer, forced flows. Annual commodity index rebalancing has been actively moving futures markets this week, creating pressure and volatility. Those flows are finite, which creates a natural after period where the market reveals the underlying bid. Third layer, physical divergence. India's retail demand is strained by elevated prices, while China's premiums widen sharply, signaling tighter supply or stronger demand in that region. Divergence like that is often the seed of arbitrage flows. Fourth layer, macro catalyst. Jobs data. And next week, inflation and spending data can swing expectations for rates and real yields, which directly impacts gold's opportunity cost and the dollar's trajectory. Fifth layer, institutional flow behavior. Even when retail is uncertain, gold and precious metals can be supported by institutional allocation cycles. ETFs, asset managers, and systematic portfolios that add on drawdowns or rebalance as volatility changes. You don't need to assume a giant one-day inflow to respect this layer. You only need to understand that multi-week accumulation cycles exist, and when the trend is strong, dips can be bought mechanically. Sixth layer, bonus, term structure and inventories. Gold futures normally trade in contango because of cost of carry. But when the front end tightens relative to the back, or when spreads behave unusually, that can be a temperature gauge for short-term availability and funding conditions. And inventories matter, but only if you understand categories. Total metal in approved warehouses is not the same as deliverable metal against the contract. Eligible is not the same as registered. And the market can look well supplied in headlines while still feeling tight at the point of delivery. That nuance is where the real signal lives. But that's not the part that matters. The part that matters is what next week forces participants to do. Because markets don't move because people believe. They move because people must. And next week forces a lot of must. If the data prints hot, yields jump, and the dollar strengthens, leveraged longs in silver and gold futures may be forced to reduce. That can push price into key support zones quickly. If the data prints cooler or the market interprets it as rate path friendly, yields can ease, the dollar can soften, and gold can attract fresh momentum, forcing shorts to cover into a thin tape. If forced index flows are fading at the same time, you can get a sharp reversal. That's the setup. And the next detail is what flips the whole thing. Because the market is not just balancing macro, it's balancing positioning. Think about who is trapped right now. There are late longs who chased highs. There are skeptics who shorted the rally and watched gold print records. There are funds that reduced exposure because volatility spiked. There are dealers who hedged options exposure at certain levels. When price oscillates around key zones, it's not random. It is the market hunting for the level where the greatest number of participants are forced to do something. That's why you see sudden drops in silver that feel like the floor disappeared. The floor didn't disappear. Liquidity did. It thinned. The book got shallow. And one large sell order hit a vacuum. Then stops triggered. Then margin calls amplified it. That's the anatomy. And once you see it, you can stop being emotionally manipulated by it. Because that's the next critical piece. The psychology shield. Volatility is a weapon. Not because someone is out to get you personally, but because volatility exploits human wiring. It makes you panic, sell the dip, and euphoric buy the top. It makes you believe the last candle is the future. It makes you confuse noise with signal. So here's the shield, and I want you to actually use it next week. First, decide your time frame before the move, not during it. Are you watching a one-week trade, a one-month swing, a multi-month thesis? If you can't answer that, the market will answer it for you by forcing you out at the worst time. Second, define what invalidates your thesis in advance, not if it goes down, I'm wrong. Something concrete, a level, a spread behavior, a premium collapse, a macro shift. Third, treat wicks as noise until the market closes. In fast markets, intraday spikes are often liquidity hunts. The close is where participants with size commit. Fourth, separate trend signal from noise. Trend signal is repeated behavior. Higher lows, sustained premiums, consistent spread tightness, persistent institutional accumulation. Noise is one violent day that reverses, and next week we'll try to trick you by giving you huge noise and then forcing you to make a trend decision emotionally. Don't. Because if this one level breaks, the math changes, but you only know it broke when it holds, when it confirms, not when it spikes. Now let's get specific about levels because vague bullishness is useless. For gold, the zone that matters first is that low 4,300 area that launched the recent surge. That's not magic, that's memory. It's where buyers proved they could absorb. If gold were to flush hard, that area becomes a key line in the sand for whether the move was a blow-off or a base. Above that, there's the mid-4400s, where gold has been trading recently. That zone is where a lot of hedging and repositioning can happen because it's near recent highs and psychologically close to major round numbers. Then there's the big psychological magnet around 4,500, because round numbers matter in options and in human behavior. If gold can reclaim and hold above that region after this week's forced flow noise, it signals that underlying demand is bigger than the rebalancing pressure. And then the record high zone, think mid-4500s, becomes the next battlefield. If price pushes into that zone again, the question isn't, can it go higher? The question is, does it get rejected violently or does it chew through? Because chewing through implies supply is being absorbed and hedging flows are turning supportive. For silver, the map is more brutal. The low 70s were the early month baseline. The mid to high 70s is where it's been whipping around recently. The low 80s is the zone that triggered a lot of emotion. Breakout headlines, FOMO, then snapback. If silver can stabilize above the mid-70s and start printing higher lows, it sets up a controlled retest scenario. If silver blasts back through the low 80s and holds, that's a squeeze scenario with gap risk, because silver can move far in a short time when liquidity thins, and that's where the real pressure starts. Now we're ready for the two scenario lens. This is the credibility anchor. It stops you from being the person who gets hypnotized by one outcome. Scenario one is the controlled pullback and retest. In this scenario, gold and silver pull back into support zones because macro data creates a temporary headwind. Yields rise, dollar firms, risk appetite shifts. The pullback scares retail. Headlines turn negative. Commentators call the top. But under the hood, physical premiums in key regions don't collapse. Spreads don't scream stress in the wrong direction. Dips get bought. Price stabilizes and retests, then pushes higher with a healthier structure. Invalidation for this scenario is simple. If premiums and spreads weaken at the same time, price breaks key supports and fails to reclaim them, the controlled retest becomes a breakdown. Scenario 2 is the continuation squeeze. In this scenario, the market gets through next week's macro gauntlet without yields exploding higher, forced index flow pressure fades, and price starts pushing back into resistance. Dealers, who are short calls hedge by buying as price rises, shorts cover. Momentum funds add. Silver, because it's thinner and more leveraged, accelerates first. You get big green candles, you get overnight gaps. You get that feeling that you're late, even if you're not. That's the squeeze psychology. Confirmation in this scenario is not price up. It's price up with spreads and premiums holding firm and with pullbacks being shallow and quickly bought. Invalidation is also simple, a breakout that fails fast, especially if accompanied by a sharp rise in yields. And a strengthening dollar often signals a bull trap, an engineered one, not by villains, but by positioning and liquidity. And if you're watching this like a pro, you don't argue with it, you observe it. Because the next detail is what flips the whole setup. Let's talk about what to watch next week like a pro, because this is where most people get lost. First, watch real yields and the dollar reaction to data, not the data itself. The number is less important than how the bond market reprices the path. If yields spike and the dollar surges and gold holds anyway, that is a statement of strength. If yields soften and gold rockets, that's a classic tailwind. But if yields spike and gold collapses through support, that's the market telling you the paper trade is dominating, at least for now. Second, watch the spreads. You don't need a Bloomberg terminal to understand this conceptually. If the front end tightens and the curve behavior suggests stress, that's a clue that availability and funding conditions are changing. If the curve behaves normally, even while price is volatile, that can mean the move is mostly paper positioning. Third, watch physical premiums, especially Asia. If China's premium stays elevated while India remains cautious, you're watching a tug of war between demand destruction and demand concentration. If China's premium collapses suddenly, that's a warning that the physical bid is cooling. If it widens further, that's a warning that paper dips may be temporary because metal is being pulled. Fourth, watch inventory categories and delivery chatter carefully, but don't get hypnotized by raw totals. The only inventory that matters for contract stress is deliverable inventory. Watch whether deliverable categories are stable or draining over time, and watch whether delivery demand rises into key windows. Fifth, watch options behavior around major levels. If price hovers and feels stuck, it might be pinned by hedging. If it breaks and accelerates with no time to breathe, hedging might be feeding it. That's your tell. And that's where the real pressure starts. Now, I want to address the skeptical viewer directly, the one who's thinking, okay, but this all sounds like a story to justify whatever happens. No, this is a framework. It tells you what to look at to avoid being manipulated by the simplest trap in markets, hindsight narratives. If gold goes up next week, you'll hear geopolitics. If gold goes down, you'll hear strong dollar. Those are surface explanations. The deeper explanation is always flows interacting with constraints. And right now, the constraints are visible in physical premiums and in the way volatility is forcing behavior. The flows are visible in index rebalancing and in hedging mechanics. The macro trigger is visible in next week's data gauntlet, and the positioning is visible in how violently silver is snapping. That's not a random mix, that's a setup. But here are the counterpoints, because you don't build trust by hiding them. First counterpoint, demand destruction is real. If prices are too high for too long, jewelry demand can stay weak, and that removes a stabilizing base. Second, if real yields surge and the dollar strengthens sharply, paper pressure can overwhelm physical support in the short run. Third, if risk assets go into a powerful melt-up and liquidity rotates away from metals, gold and silver can churn or correct even if the long-term thesis is intact. Fourth, if physical premiums cool and spreads normalize aggressively while price is still elevated, it can mean the market ran ahead of itself. None of these invalidate the entire metals thesis forever. They simply define the near-term conditions under which next week changes everything, turns into next week resets the board. And that distinction matters because smart investors don't need to be right on direction every day. They need to avoid catastrophic behavior when volatility spikes. That's the game. Now let's bring it home with a simple, concrete roadmap you can actually use. If we get scenario 1, the controlled pullback, here's what you want to see. You want to see gold respect the recent support zones, stabilize and reclaim key levels on closing basis, not just intraday spikes. You want to see silver stop bleeding and start building higher lows, even if it's messy. You want to see that physical premiums in key regions don't collapse. You want to see dips get bought rather than sold into. You want the market to feel frustrating, because bases are frustrating. If it feels too easy, it's usually a trap. And if we get scenario 2, the squeeze, here's what you want to see. You want to see gold push back above major psychological levels and hold, not just tag and reject. You want to see silver break back into the low 80s with follow-through, not a 1-hour spike. You want to see pullbacks that are shallow and bought quickly. You want to see the market refuse to give you a perfect entry, because squeezes don't. They punish hesitation and they punish chasing. And that's why you need the psychology shield. Because the squeeze scenario is where the market will try to emotionally manipulate you hardest. It will flash huge green candles to trigger FOMO. It will then snap down to trigger panic. It will make you feel stupid either way. The goal is not to feel smart. The goal is to behave well. Decide your exposure, define your invalidation, and let the tape confirm. Because if this one level breaks, the math changes, and the market will happily take your emotions as payment for ignoring that. One more layer before we end, because this is the layer that makes the title true. Why next week, specifically, could change everything. We're coming off a period where gold and silver have been moving violently, where a known forced flow event has been pushing futures around, and where global physical demand signals are diverging sharply by region. That means the market is in a rare state. It's not just pricing gold. It's pricing a tug of war between paper positioning and physical pull under the shadow of macro data that can swing yields and the dollar. In that state, 1 week can create a regime shift on the chart. Not because charts are magic, but because a week can force a cleansing. It can force weak holders out. It can force hedging to flip. It can reveal whether the bid is real when the noise ends. That's the payoff. That's why you're watching. And the last detail is what flips the whole setup. Pay attention to what happens after the forced flow period is over. If price stabilizes and starts climbing while the loud narratives go quiet, that's when you know the bid was real. If price collapses when the pressure ends, that's when you know the rally was leaning too much on momentum. Either way, you get information. And information is what you trade, not feelings. So here's your next week checklist in plain language. Watch the reaction of yields and the dollar to the big data prints, because that's the macro lever. Watch whether gold holds key supports and whether it can reclaim and hold above the major psychological zones, because that's the structural lever. Watch silver for signs of stabilization versus continued liquidation, because silver is the leverage barometer. Watch physical premiums, especially in Asia, for whether the physical bid remains stubborn, because that's the reality lever. Watch spreads and curve behavior for signs of tightness or normalization, because that's the plumbing lever. And keep your psychology shield up, because volatility will try to recruit you into bad decisions. If you can do that, you are already ahead of 90% of the crowd that will spend next week reacting to headlines. And here's the subtle truth. You don't need to predict the exact candle. You need to watch the right signals and let the market show its hand. If you're the kind of person who wants that, who wants the checklist, the mechanism, the what would break this honesty, then you're already part of the small group that doesn't get farmed by volatility. Stay with that group. Keep your eyes on the spreads, not the noise. Because next week could change everything for gold and silver, and the market will not announce the moment it changes, unless you're watching the right place.